Welcome to the webinar. My name is Guillaume. I'm your host today. This is a financial planning masterclass for business owners and professionals that are seeking true financial independence. So who is this webinar for? For incorporated small business owners, professionals who have the ability to incorporate, so you have a specific skill, whether it's software engineer, dentist, doctor, physio, you name it, marketing consultant, and you have the ability to incorporate. This is who I work specifically with, and this is who this webinar is for. And also professionals who have clients who are business owners. Think of realtor, mortgage brokers, so that you better understand what your clients are dealing with and how we work with them. Does this sound like you? These are the most common questions that we're getting from clients. What should I do with my surplus retained earnings in my corporation? Is my current corporate structure optimal based on my goals? Are you structured with an exit in mind if you have the ability to sell your business? How can I pay less income tax? My accountant is a historian, not a planner. And this is not to throw shades on accountants, but accountants are really good to work backwards and file your taxes for the previous year. We look forward and help minimize taxes over your lifetime, not just in one specific year. Does it matter if I pay myself salary or dividend? Which one is better? How do I maximize my returns on my investments based on my goals and my values in life? I need to have a conversation about life insurance, but I've been postponing it. I want to buy X, a bigger home, a cottage, a rental property. What's the best financing strategy for that? When can I start working less? I mean, this is the biggest question that we get all the time. Can I retire early? Yes or no? What does that look like? Or at least when can I know that I don't have to work as hard as I'm working right now, whether it's in my business or whether it's as an incorporated professional? This is what we can give you clarity and help you with. The problem is that those questions that you have are extremely important, but the industry is not set up to provide you answers to those questions because you're operating on an old model. A model where you go to your bank advisor and all they're doing is pitching you some mutual funds. Or you go to Wealthsimple and all they're giving you is access to the market. But investments is only one component of financial planning. There's so many other things that you're missing. And this is how we work with clients to provide you answers to these types of questions, which you're not getting currently, hence why you're listening to this webinar. Quick disclaimer, what I'm sharing you today is for educational purpose only. I don't know your specific situation. So before I actually know who you are, what you're dealing with, what your challenges, what's your situation, these recommendations can't be applied right away. Always consult an expert before applying these strategies. In the next 30 minutes or so, this is going to go really fast, guys. Every time you see on the slide a scan to book, you can book a meeting directly into my calendar and we can dive deeper in any of these topics based on your specific situation. But my goal today is to give you a glimpse of what's most important for business owners so that you are aware of certain planning options and strategies that are out there that you may be missing on that might be costing you thousands or hundreds of thousands of dollars per year. So there's 4 components that I'm going to cover in this webinar today in the next 30 minutes. 1, compensation strategies, salary versus dividend. 2nd, having a business structure with exit in mind, if you have the ability to sell your business. 3rd, how do you design an investment portfolio within a corporation? Because it's different than investing personally in your RRSPs or TFSAs. And then is it possible to expect to beat the S&P 500 index by 3% per year? Let's find out. And then finally, the most important, even if it's far away from now, how can you decumulate assets when you're in early retirement or in retirement? And how we can help you with that. The vision that we've established here at Millen Wealth Advisor is based on 3 pillars. One is we want to have a collaborative approach, meaning that we work with your accountants, your lawyers, whoever is giving you advice currently. We work with them to make sure that we're in sync and providing you the best advice. Second, the behavioral focus. A lot of your financial decisions in life are emotionally charged. Buying a home, buying a bigger home, a cottage, and it's driven by a lot of emotions and not so much from rational and objective analysis. This is what we provide you in order to help you make more informed decisions. And ultimately, it's about living your best life. You only have one shot at this, and we try to help you meet your goals as efficiently as possible so that you can be happiest as possible. It makes the biggest difference based on your values and what's important for you and your family. We're 2 planners here at Millen Wealth, Sam and myself. We're both extremely passionate about financial planning. And I started in the business because I wanted to help people. I really enjoy what I do. I love learning about what's important for you and trying to come up with the best strategy to get you closer to your goals. We're very passionate about this stuff. We appreciate the opportunity and the trust that are given by our clients, and we take this extremely seriously. This is really important, and a lot of people are not taking care of their finances, and we're here to help you maximize your chances of optimizing your wealth because you have an area of focus that is not finance, and that's where we come in, and that's who we work for. How we're set up here at Midden Wealth. So Midden Wealth is the corporation, but then we're associated with a firm called Portfolio Strategies Corporation. It's an investment dealer based out of Calgary with clients across Canada, over 30,000 clients, over 5 billion in assets. And whether your money is through someone like us or the bank or Wealthsimple or any self-directed brokers, you have the same protection as an investor, and it's the same regulatory environment, whether it's portfolio strategies being regulated by CIRO, the Canadian Investment Regulatory Organization, and your accounts being protected by the CIPF, the Canadian Investor Protection Fund. The difference maker, look, we are second to none when it comes down to client service. Lots of clients who come with us have never heard about their advisor at the bank for the past year. They also have outgrown their current advisor. Usually it's from the bank, or if they're self-directed, they're really missing out on key planning opportunities outside investments. And this is where the client service that we provide come in, whether it's quarterly check-ins, easy access to directly to us, which are certified financial planners and chartered financial analysts, fiduciary commitment, making sure that we're providing you the best advice is in your best interest based on our association with the Financial Planning Association of Canada. Believe it or not everyone in our industry are mandated to do that, which is crazy when you think about it. But yeah, we are mandated to give you the best advice, and we work for you. We don't work for a bank. We don't work for an insurance company. That's why we're independent. We work for you, the client. And everything we do is evidence-based. We use a top of the line financial planning software, and we're providing every advice that we're providing you is backed by data, and it's because we've quantified the outcome of the different scenarios. There's no gut feel, and there's no shooting from the hips here. We have the highest designations in wealth management. I'm personally a certified financial planner and chartered financial analyst. Like I said, I've been in the industry for over 10 years and various roles. I work at Questrade when I first started. I worked for Thomson Reuters, which is a financial data company. I've serviced all the major asset managers and hedge funds in Canada and the US. I've learned a lot about asset managements and the pension funds as well. I've worked and serviced, the Bank of Canada, through my time at Thomson Reuters. Like I said, all the biggest pension in Canada, lots of the largest asset managers. And then I also worked at a family office where I worked on a multi-billion-dollar investment portfolio. So I learned a lot there about how the billionaires are deploying money. And I took all my lessons and my experiences, and today I'm delivering this to you as your dedicated financial planner. And again, if you want to book an intro meeting, as everywhere that you see this sign, you can just scan it and book an intro meeting. I want to hear from you. I want to meet you and get to know you. We've got a number of awards in the industry. We've all been featured in numbers of outlets around financial planning in Canada. And what we do is we're expert at financial planning. Like I said, investment management is one component. Financial planning is much broader than that. It starts with your goals. What's the most important to you? What are your values? And then we go from there. The cash flow management, how do you pay yourself? Asset liability planning, do you pay your mortgage first or not? Do you pay other liabilities first, or do you invest? What are the trade-offs? Do you invest within your corporation, or do you invest personally? How do you invest? Which accounts do you prioritize? Do you have any life insurance in place? If something happens to you or your spouse, are your kids taken care of? Are your business partners taken care of? How much taxes are you paying per year? Can we minimize that? Can we minimize that today, but also in the next 5 to 10 years? Because that's the outlook that we need to take. And ultimately, are your goals funded? That's what's the most important. Your kids' education goals, your bigger home goals. Maybe you want to buy a boat. Maybe you want to buy a cottage. Maybe you want to travel more every year. Do you have money like set aside for that? And we help you spend guilt-free, which is the best thing in the world. If you know you can spend that money and you're on track for all your other goals, that's what we provide you with. Then ultimately is estate protection and legacy planning. What's going to happen at the end? Are you on the hook for a large tax bill if you pass away? We try to minimize that. But the most important, guys, is the implementation, the monitoring, and the coaching along the way, because there's a lot of actions, consistent, persistent actions that needs to be taken throughout the next 10, 20, 30, 40 years. This is how long we're going to be working together. We have partners that can take seamless tasks and requests on our behalf. So if you need financing for a bigger home or a cottage, we have our mortgage partners that can line up for you. It's very easy and hands off on your part. We have lawyers in our network, accountants. If you need to be introduced to some really top-notch professionals, we have some that are easily accessible, and we'll make introductions and we'll corner back the relationship as needed. So, like I said, we are kind of the primary resource for you. And then after that, we can bring you other resources that are outside our realm of expertise. Let's dive into the first topic of today, which is compensation strategy. How do you pay yourself as an incorporated professional or business owner? Salary or dividend? Well, let me tell you that whether you're paying one or the other, the tax implication is actually no, like it's minimal. It should be identical tax implications. And here's the before we show the example, let's dive into salary versus dividend and the pros and cons of each. So when you pay yourself a salary, it's a deduction to your corporation. It also generates RRSP room. It also creates the eligibility for EI or parental leave it's needed. And one of the biggest thing is it's creating CPP contributions, which can act as a guaranteed floor throughout your retirement. Maybe you'll build way more wealth than needed and CPP will become irrelevant. I don't know your specific situation, but having a guaranteed source of income adjusted for inflation during retirement can be extremely beneficial. Dividends, on the other hand, are taxed twice because they're paid out of retained earnings from your corporation, and then you get taxed personally, but then you also do get a tax credit there. You do pay lower personal tax rate, but again, when you look at integration, the outcome is actually is the same whether you're paying salary or dividend. There's also a number of notional accounts, which we'll cover in a second, that you can use in order to pay you dividend that are taxed very preferably. So if you do have those balances, you should definitely use them. Unlike salary, you have no eligibility for ER parental leave and no CPP contribution. That means once this money is paid out to you personally, you can't put in your RSP unless you have previous room. But if you don't have any room, you have to put in a non-reg account, and you don't have a guaranteed source of income at retirement. So that means you need to invest very wisely because you haven't contributed to CPP. Let's say we look at BC. If you pay yourself a salary out of business income and top marginal tax rates, you end up with, for example, 465. If, on the other hand, you earn $1,000 through a corporation, you pay yourself a non-eligible dividend, after the top marginal tax rates, you'd be down to 455. In reality, the salary, the actual amount would be lower because there's a portion that goes to CPP, but CPP is not a tax. CPP is like we just mentioned, it's an investment vehicle that will provide you a support throughout your retirement. So all in all, when you remove the CPP accounts, essentially, it's basically equal, which is a big myth in our industry. A lot of accountants are pushing from one or the other. The answer is it depends. What is the best strategy for you? We're going to cover that in the next slide. But there are a number of notional accounts that you should be aware of, and nobody knows about these accounts. These accounts are created based on various transactions. I'm going to keep it really light here, but if you have any questions, book a meeting and I'll be able to answer them, or have an accounting partner that will answer them for you. But basically, you have notional accounts. Those are not showing up in your financial statements. But whenever you, for example, if you earn over $500,000 in your business, or you realize capital gains, then GRIP will be created, or CDA, capital dividend account, will be created. And when you do realize the capital gains, then if you have CDA room, you can pay yourself a tax-free dividend. So if you do have CDA room, definitely use it. And when you receive dividends from Canadian corporations, you will see your eligible refundable dividend tax on hand, ERDTOH balance, being created. Then you can pay yourself an ERDTOH dividend by using that notional account, and then you'll get a tax credit back to your corporation. That's very tax efficient. And then you have non-eligible dividends as well. So clearing those accounts is really important. So now the question is, what's the best solution? What's the optimal strategy? Well, it depends. But ultimately, if you do have CDA balances or ERDTOH balances or NRDTOH balances, non-eligible refundable dividend tax on hand, or GRIP, then you need to clear those balances. If you don't, then that's where it comes down to paying yourself a salary. Usually we recommend up to $180,000 because it's maxing out your RSP contribution room of $32,490 in 2025. But again, that depends on your specific situation. So that's why it's usually a dynamic strategy between salary and dividend. It depends on your specific situation. Again, book a meeting if you want us to dive and discuss about this and see what's the optimal solution for your specific situation. Second point of today's webinar is the business structure with the exit in mind. Let's cover, there's two different of corporate structure at least that we're going to cover today. One is called your operating company. So your corporation is where you're earning your primary source of income. And this is called active business income. This is very important because your active business income is taxed at a much lower rate. 11% in BC, anywhere between 11 and 13% across Canada. In your operating company, you can invest in securities, in real estate, in GICs, right? But it's a separate legal entity from the person who runs it, you, the owner or the shareholder. The holding company is where it holds the profits of shares of our operating companies, usually, and it also can hold investments in securities, real estate, GICs, insurance, and you name it. But a holding company is earning passive income. Passive income is taxed at a much, much higher rate than active business income. And one of the neat thing with holding companies is when you have your operating company and then you're starting to accumulate excess retained earnings, usually you want to keep your operating company as clean as possible. And this is why you would do an intercorporate dividend from your operating company to your holding company, and you would invest from your holding company if that makes sense into your longer term plan. We'll look what's the implication of including a family trust as well here. But the reason why I'm sharing that with you is because depending on how you're structured, you can be able, or you may be able to claim the lifetime capital gains exemption when you sell the shares of your business, not the assets, the shares. So in 2025, if you sell the shares of your business, you can get up to $1.25 million of capital gains tax-free. For example, if you started a business with $100 and you sold the shares for 1.25 and 100, then you would have to realize a capital gains of 1.25 million. The taxable inclusion here is 50%, or the inclusion rate. So that would be a $625,000 taxable, taxable income. And then the tax owed on this in BC, for example, would be at the top marginal tax rate, so it would be $334,000 and change. But if you qualified for the lifetime capital gains exemption, your tax bill would be zero. That would be a $335,000 savings there. And you can multiply that $335,000 savings if you do have family members like a spouse and kids by using a family trust, which we'll cover in a second. But in order to qualify for the lifetime capital gains exemption, there are certain qualifications that you need to meet, and there are certain rules that you need to meet. Again, this is where having a tax planning expert and a tax lawyer involved really make a difference. We do have partners in our network that will be able to look at your specific situation. But what we do is we bring a lot of awareness about these topics to clients because they've never had the discussion, because we understand your goals. We understand that you want to sell your business in 5 to 7 years. And that's why we need to start planning early and involving the right partners early so that you can have the best exit possible. But there's 3 different tests. There's the asset rule test, the 90% asset rule test, the 50% asset rule test, and the ownership period. If you look here, there's 2 tests that are asking you to have at least 24 months of time frame. So you need to start planning at least 2 years before you think of selling. This is not a last minute decision. And what would not qualify you is if you own the shares of your operating company if your holding company is owning the shares of your operating company and you own the shares of your holding company, because only individuals are able to claim the lifetime capital gains exemption. So if you have that structure, that would actually put you offside. If you're flipping businesses, so if you within a 2-year period, then you wouldn't pass any of the tests. So it's really important to plan early to make sure that you can qualify for this. So what are the 2 common corporate structures that we see? Number 1 is that you own 100% of your operating company shares. But if you do have family members, this is limiting you to like that only 1.25 million. But what if you sold your company with your shares with a capital gains and realize a capital gains of about 5 million? Then you're missing out on multiplying that lifetime capital gains exemption. A scenario 2 that we see common is, like I just mentioned, your operating company shares are held by your holding company and you own shares of your holding company. That would not make you eligible to claim the lifetime capital gains exemption because, like I said, you would have to the holding company and then do the restructure. And then after that, you, depending on the, if you meet the asset test, that may put you offside, then you would be realizing a huge tax bill. So anyhow, those are two common corporate structures that needs to be reorganized if you do want to be able to claim that lifetime capital gains exemption. So one of the recommend structure that we recommend high net worth business owners to implement as early as possible as they're accruing their wealth is to have your operating company that is held by a family trust. And then the family trust has different beneficiaries. And one of the beneficiaries is a BENCO, a beneficiary company, which is your holding company. Then you and your spouse would be beneficiaries as well. So is your kids. So whenever you sell the shares of your operating company, then you can allocate the taxable capital gains to the family trust, and then you would allocate it to different beneficiary of the trust, and each of them can claim the lifetime capital gains exemption. That's how you multiply it. Again, guys, book a meeting if you want to discuss a bit further, and if you want to discuss this with one of our trusted partners as well. Now, how do you design a portfolio in a corporation? Look, the most important is not, before we dive into the portfolio itself, is asking yourself like how you invested, what are your goals, and what's the most optimal portfolio to meet your goals. This is the first question you need to ask yourself, or ask a financial planner to give you advice on that. Then is to pick which investments are best suited to help you meet your goals. That's the number two, because you can have a mix of them, and depending on which asset classes you're owning, whether you're owning equities, real estate, fixed income, or GICs, for example, in a corporation versus within an RSP or TFSA, you have different tax implications. So it's really important to work with someone who understands how investments are taxed in a corporation. For example, capital gains are taxed a lot more efficiently than eligible dividends or fixed income, interest income from fixed income or foreign dividend. Now, that doesn't mean that you should only have Canadian stocks in a corporation, but it's really important to work with someone who understands your investments within your corporation to make sure it's the most tax efficient, but ultimately that it's invested in a way that is aligned with your long-term goals. And this is why I see so many mistakes where there's misalignment between how the money is invested in a corporation and how the money is invested personally. Now, the other question too is, where do you invest? Do you keep the money in your corporation, or do you invest it personally in your RSP and TFSAs? And how do you get it out, right? Between salary and dividend? Well, it depends how you paid yourself in the first place. Do you have room in your personal accounts in the first place, right? So we need to look at all this. But the order of prioritization usually is you want to have your RSP and your TFSA maxed out, or FHSA if you have the ability to do that. And then after that, you would want to leave the money in your corporation. And so if you have room, then you need to find a way to pay it to you personally, and then after that, fund these accounts. But this is a non-tax event, guys. If you take money from your corporation and you put into your RSP, it's a non-tax event, right? So that's why it's important to have the right compensation strategy in place, and then the right the investment account location strategy. That's the right term, in order to prioritize the right account and investing in the right place so that you can minimize your overall tax bill. The biggest investment mistakes I see people making: number one, stock picking. This is a stat about the investment managers, professional investment managers. Those are not your advisors or you retail investors. Those are like the top-notch investment managers around the world. 92% of them over a 15 period fail to beat a simple benchmark like the S&P 500 index. It's really hard to beat index funds. And there's no point of trying to pick who's the 8% who may be able to beat the broad market. So the first thing is be exposed to the broad market and make sure you have as much money as invested as possible in the right asset classes to help you get closer to your goals without trying to pick which stocks are going to do well, because that's a waste of time in your overall financial plan. The second mistake is being fearful and staying on the sideline. For example, if you have $10,000 invested over a 19-year period in the S&P 500, you would have had $65,000 today. But if you missed the 7 best days in the market over a 19-year period, you would have been down to $30,000. And a lot of this, the biggest mistake I see, people having hundreds of thousands of dollars just sitting in their corporate account. That's usually tax inefficient, but also it's not getting you closer to your goal. It's a waste of opportunity, guys. And that's what we help you with, align your investments with your long-term goals. So your question might be, so what is a good investment? But the question is, what is a good investor? And I'm going to go through this really quickly because I don't want to take too much of your time, and I want to speak to you directly via an intro meeting. But the right investor, guys, is someone who has a sound investment philosophy. And I'm going to be very quick on this. And after that, that's going to bring us to the end of this webinar. But you need to have core principles that govern your investment philosophy. And here we have four here at Men and Wealth. Number one is we know that research have identified some key long-term drivers of returns. You don't have to speculate or look into your crystal ball or try to make bets on Bitcoin or other speculative asset classes. There are long-term drivers that we can rely on in order to help you and grow your money. Second is diversification. Diversification, it's the only free lunch in investing. Third is ignoring stock market dips. Everyone is piled in the latest trend, but we take a more objective way and try to diversify you from the latest and the shiniest that is always in the news and try to capture investment opportunities that people are overlooking. And fourth is staying disciplined through market highs and market lows. And that's where your plan is essential, because the plan is driving everything else. And that's how we're able to remove the emotions from you wanted to maybe buy or sell depending on your specific situation, but or selling at the wrong time or making mistakes that can cost you hundreds of thousands, sometimes millions over your lifetime. And we try to minimize that by having a really sound plan and then staying disciplined based on the plan. We always go back to the plan. Now, in the investment side, which U.S. asset class index has outperformed the S&P 500 index since 1927 by 3% per year on average, and how can you capture it? Well, there are few gentlemen that over the history has published research and has found empirical evidence and has won Nobel Prize winners, Nobel Prizes, about their discovery that happened at various times, but some goes back to 70 years ago that some people are still not implementing today. And we've been knowing this stuff for 70 years. One of them is the modern portfolio theory. So very quickly, guys, the concept of risk adjusted return, so trying to get the highest amount of risk by the highest amount of return with the least amount of risk. That's the concept. The second was William Sharpe when we introduced the correlation between risk and return. So the higher return you want, the higher risk you need to get in general. And then finally, Fama and French, when they came up with the 3-factor model, where they discovered that there were certain anomalies in the market, and they're like, well, why certain stocks are outperforming the S&P 500 over long periods of times? Is it because there's something special about them? No, it's just because they have certain characteristics. This is what I'm going to literally summarize in one slide for you. There's basically 3 aspects of the market that you want to have in your portfolio that most people don't. Most people are piled into the latest and shiniest growth stocks. And in the short term, they may have done well, but it's important to have value stocks, high profitability stocks, and small cap stocks in your portfolio. And this is where you see the outperformance over the S&P 500 index. This is a disclaimer, guys. This is a research based over the last, 1963, but we have other research that goes back to 1927. And this is based on indexes. So portfolios may differ than indexes. But the point that you need to know is you need to have a portfolio that is well diversified, not just invested in the latest and shiniest that are actually expected to underperform going forward, versus stock that may be unloved or less followed that have a higher expected return based on their valuations. And this is why your true diversification comes in. So have value, have growth, but have value in your portfolio. Have high profitability stocks in your portfolio. Have large cap and small cap in your portfolio. Now, the retirement puzzle, this is the biggest question. This might be far away right now. and you might not be thinking about retirement, but it's important for you to know that you need to start by looking at your furthest goals, and then we want to plan all the way back to today, right? So forward looking, backward planning. And your retirement is going to be influenced by a number of factors: how much you need to save, when you want to retire, how much to withdraw, your investment risk, your longevity, how long you're going to live, the taxes, are you going to receive government benefits, psychological factors, how much are you going to actually spend in retirement. All those factors, we quantify them for you, and we help you to basically already plan a decumulation strategy, because this can add millions to your net worth. I'm going to show that to you in the next slide. But you're going to have a number of sources of income at retirement. Can be CPP and OAS, your rental income if you have an investment property, corporate income from your holding company, your RSPs and TFSAs, your non-reg accounts. How do you decumulate this amount? There's various strategies that we can utilize to help you minimize your taxes and maximize your wealth when you're going to be in that stage of life, even if it's far away. This is a real client example, guys. We've added $1.6 million to their expected net worth just by optimizing when they can, what should they withdraw based on the account prioritization. So where do they withdraw the money and when? This is real planning, guys. This is what we deliver you. And this is the impacting how much you need to save today. So that means that you might be able to spend more today. You might, have a lot more peace of mind about your financial trajectory. And you might just be way less stressed about, where you're heading financially. This is the type of impact that we can have for you to help you live, a more fulfilled life and make a bigger impact for you, your family, and the causes that you care about. And ultimately, when you're going to be in retirement, this is the retirement portfolio rebalancing strategy. So you have different targets, different spending targets per year, and you're going to be relying on your portfolio depending on the different sources of income that you have. And then we are going to just maintain your targets throughout your retirement based on your spending needs. And then we'll be rebalancing this throughout your retirement. And this is where the true peace of mind comes in, because you already have at least a year or two of allocated funds that are already covering your spending. So whether there's a market crash, a recession, economy, tariffs, Trump, political wars, or anything that may be in the news that may be causing you stress, we take the stress out of the equation, because we've already have a plan and we've already accounted for things that we don't know may happen. But this is the thing, is we want to be accounting for the unexpected. This is where the plan comes in. And diversification is the only free lunch in investing. Whenever there's a certain markets movement, it's just rebalancing your portfolios towards your targets. Now, your financial journey, you might think that you're going to start your business, retire, sell your business, and then live happily ever after. And I wish you that this is going to happen. But if you're like anyone else, you might want to book a meeting, because your reality might be different. You might have had married, you might go through a separation, you might be divorced, you might want to keep your assets, you want your assets to go to your kids, maybe, and then some portion to your spouse's kids, but you might have some separations there. There might be some planning. You might want to sell your business. There's some years you might be making a lot more than you thought. There's some years you might be making a lot less than you thought. Your income might be extremely volatile. You might change careers. So many things in life. Your health might be impacted. There's so many things in life that will happen in the meantime that we can help you plan with and remove the stress from the equation. And this is what we provide at Mint Wealth. We will cover, all aspects of financial planning on the comprehensive side, right? Especially for business owners. I just covered 4 of them today, but there's so many things that we need to look at to make sure that you're optimizing your wealth. We're going to coach you along the way. We're going to help you implement. This is where you have a certain expertise in one field and you're relying on us to implement the strategies that we put forward. We can coordinate with your professionals depending on who's advising you as well, and we can work with them to make sure that we're in cohesion and giving you the best advice. And through our fiduciary standard, you can be assured that what we put forward is in your best interest. Not everyone is actually thinking that way. And now you might be advised by someone who needs to meet a sales quota, or is actually, benefiting the bank when it's benefiting you. And ultimately, it's like you're getting independent advice. We don't work for a bank. We don't work for an insurance company. We work for you. So if that resonates with you, book a intro meeting. And if you're a business owner who's coachable and you want to delegate your financial planning to an expert, we are the right party for you. So I'm looking forward to meet you on the call. Book that meeting. It's free, no charge, no commitment. I'll get to know you a little bit better. I'll ask you a number of questions to see if it's a good fit. And if it's not a good fit, I'm going to leave you with some pointers where regardless, you're going to have learned through this process and you're going to be in a better position, whether we work together long-term or not. Thank you for watching this webinar, and I wish you a wonderful rest of your day. Hopefully I'll see you on the call soon. Bye.